What nobody tells you about loans and what you need to know to survive in today's financial landscape. Most people focus on the monthly payment, but that's exactly what banks want you to do. Today, we're going to pull back the curtain on the multi-billion shilling industry of interest and show you exactly how to keep more of your hard-earned money. This isn't just about debt, it's about your freedom. We're going to explore the hidden mechanics that keep millions of people in a cycle of perpetual repayment. And more importantly, we're going to give you the exact roadmap to break those chains forever. Welcome to Money Up Academy. In today's fast-paced economy, loans have become a fundamental part of life for almost everyone. Whether it's a SACCO loan for your business expansion, a bank loan for your first family home, or those quick mobile service loans to cover a sudden emergency, we are constantly navigating a sea of debt. But while these tools are marketed as solutions to our immediate needs, they often come with a hidden weight that many of us ignore until it's too late. The ease of access, getting a loan with just a few taps on your screen, has changed our relationship with money. It has made borrowing feel like a normal, everyday occurrence. But every time you borrow, you are committing a portion of your future labor to someone else. Today, we are going to look at why the structure of these loans matters far more than the initial amount you receive. We'll examine the systemic pressures that push us toward longer terms and why your bank manager is always smiling when they offer you a lower monthly payment over a longer period. Interest is the price you pay for using someone else's money today, and it's the engine that powers the world's most profitable financial institutions. To understand why you're paying so much, you have to understand the business model of a lender. Their goal is to maximize the yield on every shilling they lend you. They do this by keeping your money in the repayment zone for as long as possible. Loans can be helpful, particularly when investing in high financial commitments like properties or education, assets that can appreciate and generate their own return. However, they also come at a big cost: interest. This cost is often buried in complex terms and conditions, but it's the most significant expense you'll ever face. We are going to break down how to calculate this cost for yourself, so you're never caught off guard again. Understanding interest isn't just for accountants. It's a survival skill for the modern world. But here is the real secret. The longer you take to repay a loan, the more interest you end up paying. It sounds simple, but the compounding effect over years is staggering. Banks and SACCOs know this, which is why they've been happily increasing the repayment periods for their loan products. They are making it easier to say yes, but harder to get out. Let's look at the mechanics of amortization. In the beginning of your loan, most of your monthly payment goes toward interest, and very little goes toward the principal, the actual amount you borrowed. As time goes on, this ratio shifts. By choosing a longer term, you are essentially staying in that high interest phase for a much longer period. You are paying for the privilege of time, and that privilege is extremely expensive. We are going to show you how to read your amortization schedule like a pro and identify exactly how much of your hard-earned money is being sucked away by the clock. This is where many people get trapped. They see a flat rate of 10% and think it's cheaper than a reducing balance rate of 14%. But it's a trick. With a flat rate, you pay interest on the full original amount for the entire duration, even after you've paid back half the loan. With reducing balance, you only pay interest on what you still owe. This one distinction can save you hundreds of thousands over a long-term loan like a mortgage or a major business expansion. Let's take a closer look at the numbers. On a 500,000 shilling loan, a 10% flat rate over 5 years means you pay 50,000 in interest every year, totaling 250,000. But a 14% reducing balance rate might actually end up costing you less in total interest because your principal is constantly shrinking. Always ask your lender, is this flat or reducing? If they won't give you a straight answer, that's your cue to walk away. Knowledge is your first line of defense against predatory lending. Imagine this. You borrow 500,000 shillings at an interest rate of 14% per annum. Under option 1, you repay this over 6 years. That's 72 months. Your monthly payment is about 10,303 shillings. It feels manageable, right? It fits neatly into your monthly budget. But look at the total. you end up paying back 741,816 shillings. That's over 241,000 shillings just in interest, nearly half the original loan. Now consider option 2, repaying that same loan over just 3 years or 36 months. Your monthly payment jumps to approximately 17,089 shillings. It requires more discipline and a tighter belt, but the result is incredible. Your total repayment is around 615,000 shillings. You've just saved over 126,000 shillings. That is money that stays in your pocket for your next goal. 126,000 shillings is a life-changing amount for many. It could be a down payment on another asset, a business seed, or your children's future. Why do we choose the longer path? It's psychological. Our brains are wired to focus on the immediate cost, the monthly bill, rather than the long-term consequence. This is known as hyperbolic discounting. We value small rewards now more than larger rewards later. Banks capitalize on this by offering lower monthly payments that stretch out for years. They make the now easy, so you forget about the future cost. Breaking this cycle is the first step to wealth. You have to train your brain to see the total cost of credit rather than just the monthly installment. When you start seeing that extra 100,000 shillings leaving your pocket, the shorter term starts to look a lot more attractive. We are going to discuss some mental frameworks to help you stay focused on the long-term goal of total financial independence. It's about taking the power back from the lenders and putting it into your own hands. Think about that 126,000 shillings. If you took that exact saving and invested it into a diversified index fund or a solid SACCO investment account at 10% annual return, it could grow to over 800,000 shillings in 20 years without you adding another cent. This is how wealth is built. It's not just about saving the interest, it's about the opportunity cost of that money. Every shilling you pay in interest is a shilling that isn't working for you. It's working for the bank's shareholders instead. By choosing a shorter repayment period, you are essentially investing in yourself. You are choosing to be the one who earns interest in the future rather than the one who pays it. We'll explore some common investment vehicles where you can put your interest savings to work, ensuring that your sacrifice today leads to a massive payoff tomorrow. This is the difference between surviving and thriving. But you cannot attack your debt without a shield. That shield is your emergency fund. Many people try to pay off their loans aggressively, only for a car breakdown or a medical bill to force them into taking another high-interest mobile loan. It's a 2 steps forward, 3 steps back cycle. Before you tighten your belt to pay off that loan in 3 years, you must have at least 1 to 3 months of basic expenses saved up. This fund protects your progress. It ensures that when life happens, and it will, you don't have to go back to the lenders. It gives you the peace of mind to stay the course. We'll look at exactly how to build this starter fund even when your budget is tight, identifying those small leaks in your spending that are currently holding you back. This is the foundation of the money up philosophy. Protect yourself first, then conquer your debt. Now, let's get practical. How do you find that extra 7,000 shillings a month to move from option 1 to option 2? We are going to open up the Money Up budgeting template and do a line-by-line audit. Most people are shocked to find they are spending 5,000 shillings a month on subscriptions they don't use, or 10,000 on black tax that isn't planned for. These aren't just costs, they are your keys to freedom. If you can find just 5,000 shillings extra each month, you can transform your financial future. We'll walk through the 50-30-20 rule and how to adapt it for a high debt situation. We'll also talk about the latte factor, the small daily expenses that add up to a fortune over time. This isn't about deprivation, it's about intentionality. It's about choosing what you want most over what you want right now. Get your pens ready because we're going to build your personalized debt-killing budget together. If you have multiple loans, maybe a bank loan, a SACCO loan, and a mobile loan, you need a strategy. The debt snowball focuses on the smallest balance first to give you a psychological win. The debt avalanche focuses on the highest interest rate to save you the most money. For most people at Money Up Academy, we recommend the snowball for the first 2 small debts to build momentum, then switching to the avalanche for the big ones. We'll walk through a case study of a family with 4 different debts and show you exactly how they cleared them all in 24 months instead of the planned 60. It's about strategy, discipline, and a clear vision of your debt-free life. You are not just paying a bill, you are buying your freedom, 1 shilling at a time. We'll help you decide which method is right for your personality and your specific financial situation. This principle applies even more aggressively to your largest loan, the mortgage. Let's compare a 15-year mortgage to a 30-year mortgage on a 5 million shilling home at 12% interest. On the 30-year plan, your monthly payment is about 51,000 shillings. On the 15-year plan, it's 60,000. That's only a 9,000 shilling difference per month. But the 30-year mortgage will cost you over 13 million shillings in total interest, while the 15-year one costs only 5.8 million. You save over 7 million shillings just by increasing your monthly payment by 9,000. That is the power of shortening your term. Banks love the 30-year mortgage because it's a gold mine for them. At Money Up Academy, we want you to own your roof, not rent it from the bank for 3 decades. We'll dive into how to accelerate your mortgage even if you're already in a 30-year plan. But it's not just about the interest rate. There are hidden costs that can make a low-interest loan very expensive. We're talking about processing fees, appraisal fees, credit life insurance, and even legal fees. These can add up to 3 to 5% of your total loan amount upfront. Some lenders roll these fees into the loan itself, meaning you pay interest on your fees. We'll show you how to read the total cost of credit disclosure form. In Kenya, banks are required to give you this form. It's your right to see the full cost, including all these hidden extras, before you sign. We'll teach you which fees are negotiable and which ones you should never pay. Don't let the headline interest rate blind you to the true cost of borrowing. A 12% loan with 5% in fees might be more expensive than a 14% loan with no fees. We'll do the math together. Now, let's address some of the most common questions we get here at Money Up Academy. Question 1. Should I use my savings to pay off my loan? The answer depends on your interest rate. If your loan is costing you 14%, but your savings are only earning 8%, you are losing 6% every year. Pay it off. Question 2. What if I lose my job while on a shorter repayment plan? This is why the emergency fund is non-negotiable. It's your safety net. Question 3. Can I change my repayment term midway? Yes, most lenders allow you to make extra principal payments. Every extra shilling you pay goes directly to the principal, shortening your term automatically. We'll look at 3 more specific scenarios, including handling debt collectors and what to do if you're in a debt trap. This section is all about real-world solutions for real-world problems. Knowledge is your best weapon against financial stress. Ultimately, your relationship with debt is a reflection of your relationship with your future self. Every time you choose a shorter repayment period, every time you skip a luxury to pay down a principal, you are saying that your future freedom is more important than today's comfort. This mindset is what separates those who struggle from those who thrive. It's a marathon, and there will be days when it's hard. But the peace of mind that comes from owning your assets outright, knowing that every shilling you earn is truly yours, is worth every sacrifice. You have the knowledge, you have the strategy, and now you have the plan. Don't let the banks win. Take control of your loans, take control of your interest, and take control of your life. Let's make this your year of financial breakthrough. This is Money Up Academy, where we build wealth one decision at a time. Subscribe to Money Up Academy for more financial wisdom that puts money back in your pocket. Check out our website for free templates and resources to help you on your journey. We're in this together. See you in the next one.